In March 2026, the Strait of Hormuz, which handles 20% of the world's seaborne oil, went silent. Not because of missiles, not because of mines. Because of an insurance clause. And the thread that led to that moment started not in Tehran, not in Washington, but in a quiet New Zealand office where a UK citizens' P&I club was underwriting 1/6 of Iran's shadow fleet. That loophole allowed $34.9 billion of sanctioned oil to keep flowing. The U.S. maximum pressure campaign expanded sanctions again and again, aiming to drive Iran's oil exports to zero. The Treasury designated 10 entities and 17 vessels as blocked property, targeting what it called a significant portion of the shadow fleet. The State Department went after services that enabled ghost fleet vessels to conduct ship-to-ship transfers outside Southeast Asian port limits. Iranian crude still flowed, hidden by a maze of shell companies in Panama, which alone flagged 17% of ghost fleet vessels, along with Hong Kong, Liberia, and UAE. Tankers frequently changed flags and disabled AIS transponders to mask their movements. But no deception could bypass the need for P&I insurance, the ticket to any major port. And that's when an unassuming office in New Zealand provided the backdoor. Operating from a simple office park, the club was underwriting billions in sanctioned oil, far removed from the London insurance heartland. In October 2025, Reuters exposed that Maritime Mutual insured 231 tankers. 130 of them had hauled sanctioned Iranian or Russian oil, worth $34.9 billion combined, $18.2 billion of Iranian crude and $16.7 billion of Russian energy products since sanctions took hold. That's 1/6 of Iran's entire shadow fleet, a dominance far exceeding that of other major actors in sanctions evasion, according to a former U.S. Treasury sanctions specialist. The valve had been opened. Behind Maritime Mutual was a single UK citizen, Paul Rankin. Operating out of Auckland and Christchurch, his club provided the insurance that kept Iran's ghost fleet sailing. P&I insurance is not a luxury, it's the mandatory shield that covers third-party liabilities, pollution, and crew claims. Without it, a tanker is barred from every commercial dock. The global P&I system relies on 13 clubs, almost all based in London. Maritime Mutual operated outside that circle, registered in New Zealand, a loophole that gave Iran's ghost fleet a legal passport. The London-based international group of P&I clubs cooperates tightly with sanctions enforcers, but Maritime Mutual, a standalone club, fell outside that framework. Its policies became the equivalent of a diplomatic passport for ghost tankers. Between 2018 and 2025, ships insured by Maritime Mutual disabled their AIS transponders at least 274 times, according to Global Fishing Watch tracking data. Those blackouts were concentrated around known ship-to-ship transfer zones, the Gulf of Oman, off Fujairah, and the South China Sea, where vessels swapped cargoes in the dark to obscure origin. No coincidence, each disappearance hit a sanctioned delivery. In 2025, New Zealand police raided the firm's offices, launching investigations into possible money laundering and terrorism financing. For years, a tiny P&I club had been the invisible chokepoint that allowed sanctioned oil to reach global markets. By early 2026, war risk insurers were watching the Strait of Hormuz nervously. Premiums for a single transit had jumped from 0.125% to 0.4% of a vessel's value, adding $250,000 per trip for a very large crude carrier. Then, on March 5, 2026, protection and indemnity clubs and war risk insurers withdrew all cover for ships passing through the strait. The clause was simple: nothing is covered. By March 9, marine insurance rates for the strait had surged 4 to 6 times over the previous week, and the U.S. government began offering insurance support under the Terrorism Risk Insurance Act, but it was too late for the ordinary shipowner. Without insurance, no bank will finance the cargo, no port will accept the tanker. In hours, the busiest waterway for seaborne oil became a financial exclusion zone, forcing shipowners to reroute or anchor. The fine print had done what no anti-ship missile could: it had cut 20% of global oil trade without firing a shot. The fallout was immediate and brutal. By March 10, oil production from Kuwait, Iraq, Saudi Arabia, and the UAE had collapsed by 6.7 million barrels per day. 2 days later, the loss exceeded 10 million barrels. Brent crude surged past $126 a barrel, the largest monthly price jump ever recorded. The International Energy Agency called it the largest supply disruption in the history of the global oil market. On land, the strait closure triggered a grocery supply emergency across Gulf states. Supermarket shelves in Dubai and Riyadh emptied within days. Staples like rice and cooking oil vanished from shelves. Digital payment apps in the Gulf froze as banks struggled with volatility. 70% of the region's food imports were disrupted, forcing retailers to airlift staples. Consumer prices for basics spiked between 40 and 120%. The economic shockwaves reached every Arab nation, with a UN study estimating a GDP loss of $120 to $194 billion. Washington retaliated. The Treasury designated 10 additional entities and identified 17 more vessels as blocked property, widening the net over Iran's entire shadow fleet. The State Department targeted the Ghost Fleet's ship-to-ship operations in Southeast Asia. Meanwhile, New Zealand investigators deepened their probe into Maritime Mutual. The insurance backdoor that had propped up 1/6 of Iran's oil exports was now under siege from both sides. The economic warfare had entered its most decisive phase. Sanctions used insurance not as collateral damage, but as the primary trigger. By weaponizing the P&I clause, Washington had replicated the exact mechanism that closed the strait. But the shadow fleet didn't disappear. Within weeks, tankers began reflagging to West African registries like Cameroon and Comoros, and even Togo and Gabon, tiny registers suddenly handling supertankers. New shell companies in Zanzibar and Cyprus filled the gaps left by Panama, which had once flagged 17% of ghost ships. The insurance choke point shifted to digital trade platforms and blockchain-based marine cover, a realm where sovereign sanctions are far harder to enforce. Digital policies powered by smart contracts can automatically pay out if a ship is detained, without human intervention. The weapon that closed the strait may soon be obsolete, because the next financial choke point is being written in code, not in the fine print of a P&I club. On a distributed ledger, no single government can pull the plug. In the end, the Strait of Hormuz was sealed not by warships, but by a withdrawn insurance clause. A New Zealand P&I club, a web of shell corporations, and a handful of lines in a contract had moved more oil than any pipeline. The weapon was invisible, and it worked. And as the world focuses on the geography of choke points, the next one is already being drafted, not on paper, but on a blockchain, where the ink is code and the gatekeeper is an algorithm. When the insurance clause mutates into a smart contract, sanctions enforcers may find their targets have no office to raid.